Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think ultimately there's no way that we're going to have long-term tariffs on oil because it would mean much higher inflation for U.S. consumers. So I think this is a game of chicken. I would fade it in the long term. This is a bit of gamesmanship by President Trump, in my opinion.
If you zoom out a bit, the biggest thing that I see that's shifted is just the broadness of this market. We have 10 out of 11 sectors up this year. And it's not just a U.S. phenomenon, right? Yes, so the U.S. is up, the average stock is up, small caps are up, mid caps are up, but international markets are up, emerging markets are up. There's more opportunities. It's not just one or two sectors that are driving this right now.
I think artificial intelligence is something that is very exciting. I think we are going to have to start seeing some useful end user facing products and applications come to market to make investors comfortable with the amount of investment that's being deployed towards this technology. So I think artificial intelligence will be both a big risk, as we saw this week, but also a big opportunity.
We got 1 hour to go until the market close, and we're taking a look at the major averages here. Everything hinges on tariffs, which the administration has said it is going to implement on February 1st, Canada and Mexico. And there's been a lot of back and forth. The market is very attentive to all of the headlines. Right now, we've got the Dow that is taking the brunt of it here, down 307 points or so, about 2/3%. The S&P 500 down 0.4%, and the Nasdaq down about 0.2.
It was interesting because earlier today, it kind of felt, Julie, like investors were sort of, I don't know, were they kind of taking the tariffs in stride? I wasn't really sure, or maybe they just thought it wouldn't happen, or if it did happen, it would only get partially enacted. It wouldn't be as bold as the talk. But as you said, the headlines keep coming fast and furious, and so people are thinking, okay, how am I actually positioned?
Right. So a couple of ways to look at this where we're really seeing concentrated reaction. One, of course, is in currencies, because this has big implications for the dollar versus other currencies. So this is the dollar versus the Canadian dollar. And you see here the dollar going lower, the US dollar, and then coming back here. So in other words, the dollar strengthening against the Canadian dollar ahead of the implementation of tariffs, reacting to the various headlines today. And then you got the Mexican peso, similar kind of reaction there. We've also been watching it play out in the things like the automakers and auto parts makers. Here's a graph of some of the auto dealers, and most of them are in the red here today. So seeing that play out in various ways. And then, of course, we're also watching other areas like oil. I'm going to get to that because we had Exxon and Chevron both reporting today. Both of those stocks are down, both of them being hit in their refining margins. In other words, it costs them more to convert oil into gasoline. And guess what? They import oil from Canada to turn into gasoline. So that's a concern.
I mean, you saw fuel profits tumble was part of it. Then also, obviously, this bigger question now, back to tariffs. Do you get tariffs slapped on Mexico and Canada? If you're in these names, you're trying to figure out, would oil be included in that? Because you're right, Julie. Of course, those are important sources of crude for the American refineries.
Right, and there's a potential for oil to be exempted. But we just don't know. We won't know until we know. And then finally, outside of tariffs, there's a lot going on, right? Outside of tariffs, we are watching shares of Apple, which were higher earlier in the day following their earnings. Well, even after the numbers last night, as you and I saw in real time, the stock was bouncing around. It settled higher, was higher, and then faded with the rest of the market as the day has gone on.
Yeah, I mean, the results were, I think it was better than feared, was part of it, sigh of relief. I spoke to Apple CFO Kevin Parekh about it. I thought it was interesting how Kevin emphasized that Apple Intelligence is driving upgrades, right? So I think when investors were then thinking, okay, if that's true, when do Chinese regulators give the green light to Apple Intelligence? And if that happens, investors then trying to game out, if and when that happens, of course, what would that actually mean for end market demand? But you can see that the tape here today, green to red. read.
Yeah, a lot of gaming out today.
All right. President Trump ready to impose tariffs on Canada and Mexico starting Saturday, February 1st. The two largest trade partners with the U.S. White House Press Secretary Karoline Leavitt also saying a 10% tariff will be levied against China. Now let's take a closer look at imports from Canada and Mexico and how you may feel the effects of the tariffs.
So let's go through it. The top imports from Canada are for industrial supplies. That includes oil products, lumber, and aluminum. Crude oil imports from Canada hitting a record high last year at more than 4 million barrels per day. Much of that gets refined into gasoline in the U.S., so oil companies will now have a choice: charge more for gas or eat that increased cost. But even on grocery shelves and restaurant menus, you could see the effect of Canadian tariffs. 81% of frozen French fry imports to the U.S., they're from Canada.
And to our neighbor to the south, the auto industry is set to be hardest hit by the tariffs on Mexico. A report from S&P Global Mobility noting nearly every automaker and supplier would be affected. GM CEO Mary Barra saying the company has plans in place for tariffs, but did not account for them in future guidance. But mentions of tariffs on earnings calls so far skyrocketing this earnings season. Also remember, about half of U.S. fresh produce imports are from Mexico, and nearly 80% of all avocados are from Mexico too. Well, the White House says tariffs on Canada, Mexico, and China will start Saturday after a report said they'd be delayed by a month to March 1st. Joining us now to break it down is our own Washington correspondent, Ben Worschel. Ben.
Hey guys, yeah, you just laid out the economic stakes there here too, and I've been covering the kind of the political back and forth today. And what we have is a real sort of whiplash day that's a bit left us where we began. You mentioned some of this, but Trump on day one has promised that starting tomorrow there would be tariffs of 25% on Mexico, Canada, and 10% on China. He reiterated that plan last night, and then there was a Reuters report today that maybe he's going to delay some of it, that he would delay the actual implementation until March 1st. That was clearly a market-friendly headline, but it only lasted about an hour. Karoline Leavitt said, flatly denied the report, called it false, and said, quote, starting tomorrow, those tariffs will be in place. The larger sort of political context here is that this is, by my count at least, the third time that a kind of market-friendly, moderate idea on tariffs has been floated, and markets have reacted, but then it's been immediately kind of smashed down by the White House, who's very determined on these tariffs, very determined to sort of be seen as going forward on these tariffs. And where it leaves us now is just a few hours from this deadline. Karoline Leavitt has said that we won't have the details until tomorrow morning, and the business world kind of in a lot of an uncertainty about this. Trump is set to speak this hour, so I may be back with you guys before the end of the show because it may change again, but that's sort of where we stand at the moment.
Well, and Ben, it's not even just about whether or not tariffs will be imposed, it's on whether there will be exemptions. And specifically, I know you've been looking into a potential oil exemption. What do we know about that?
For sure, yeah. Well, Trump brought this up last night in talking to reporters, and oil specifically. He said that, we may or may not include oil in the tariffs. That was the first time he said things like that, and said it was price dependent. And markets, you mentioned markets in general have been focused on this. Oil markets and the energy sector has been keenly focused on it today, trying to make sense of it. I did some reporting talking to energy officials, and one take here is that this is a positive, that kind of once you get past the Trumpian bluster, we don't need oil, we're gonna drill baby drill. This is actually an acknowledgement of how disruptive putting a tariff on oil would be. There's lots of reasons that the energy folks will tell you that mixing our light crude with the heavy crude from Canada is needed, and it would be really disruptive. It's not a matter of replacing it. But again, there's a lot of unanswered questions here. Karoline Leavitt today didn't answer any questions on exceptions, said we'd have to wait till tomorrow to see that. So the oil sector in particular is focused on this, in addition to all the other tariffs.
Just have to keep waiting, Ben, is the bottom line. But there's not too much longer to wait, at least.
I know, yeah.
All right, thanks a lot. Appreciate it.
Thanks, Doug.
It has been a back and forth day for President Donald Trump's proposed tariffs, but the end result is that we will, it looks like, see 25% tariffs on Mexico and Canada and 10% on China starting this weekend. For more, we're bringing in Ernie Tedeschi, Director of Economics for the Budget Lab at Yale University and former Chief Economist at the White House Council of Economic Advisors under the Biden administration. Ernie, thank you so much for being here. We're all trying to make sense of this, obviously. And one of the things we're trying to make sense of is what effect it will have on regular people, right? We were just talking about lots of different imports that come to us from Canada and Mexico. I always think of avocados. We eat a lot of avocados in my house. But how do you go about quantifying it, and what will be the hit potentially for U.S. households?
Yeah, so I think about the aggregate hit, and then I think about the timing. So in aggregate, when you think about the average household's basket, 25% on Canada, Mexico, 10% on China translates to about a 0.8% increase in the overall price level. Now, that doesn't sound like a lot, but you translate that for the average household, and that's about a $1,300 loss in purchasing power every year. That's a meaningful amount. That's about half a year of normal inflation happening in one fell swoop. In terms of timing, I think that households will see disposable items like groceries, like the fresh produce that you mentioned from Mexico, that will increase in price very quickly. Whereas I think more of the durable goods, like cars and auto parts, that will take some time for consumers to see the prices reflect tariffs, because automakers and retailers will work through the tariff-free inventory that they already have before they get to the tariffed inventory.
Ernie, why do you think Trump supports tariffs so wholeheartedly the way he does? Is it because he thinks they're revenue raisers, encourage domestic manufacturing, national security, all of the above?
All of the above. I think that he sees it as a way to protect domestic industry and as a way to raise revenue. The problem with that is that those two goals are in conflict with one another. If tariffs work as advertised to reduce imports and protect American industry, then by definition, you're not raising as much money from tariffs to offset what the purpose is this year, which is to pay for the extension of the 2017 tax cuts. I would note that as advertised, this slate of tariffs would probably raise about $1.5 trillion over 10 years if it were fully implemented on all goods, including oil, and stayed in place for 10 years. That's only about a third of the cost of extending the 2017 tax cuts. And then if you start talking about exemptions on top of that, exempting oil, exempting specific companies, you're going to raise even less, right? So this doesn't even come close to meeting the price tag of the tax cuts they're talking about.
Ernie, there are a lot of, obviously, just encapsulated in your answer there's still a lot of questions here, right? Are there going to be exemptions? What is this going to mean for inflation? What is it going to mean for collection of tariff revenue? One of the other questions is around growth, right? And looking back at the first round of tariffs under the first Trump administration, we saw the Federal Reserve, and this comes to us courtesy of Bloomberg, we saw the Federal Reserve changing its 2019 GDP growth targets, kind of trying to tweak them as we got the different tariffs and tried to figure out what the effect would be on growth. Ultimately, they brought the estimates lower. What do we know this time, or what is it going to hinge on this time, I guess, in terms of the hit to growth?
Yeah, it's a good question. On the one hand, these are bigger tariffs than the Trump administration proposed or tried to implement the first time around. Our estimate is that this slate, again, assuming that it was implemented on all goods, would probably translate eventually to a lower level of real GDP of 0.2% in the medium term. And by that, I mean like after 3 or 4 years. So that's meaningful. On the other hand, the Fed has said that in terms of inflation, it's going to try to look through the tariffs, meaning that it sees tariffs as a one-time price level increase, not inflationary, but just something that affects the price level once. And so it doesn't really affect its inflation mandate. Now, that is, the way that the monetary policy book is written, and that's certainly, the proper way to conduct monetary policy. I worry that the actual data are going to get messy because, CPI and PCE doesn't cooperate and tell you what inflation is X tariffs or X imports. It's all mixed together. And so I think that Fed is going to have a hard time this year, worrying about a soft landing, distinguishing between tariff effects versus immigration effects versus deficit effects versus who knows what other, price effects might be coming up this year that we haven't even anticipated yet.
Ernie, I've heard some economists suggest that Trump has the leverage here in this back and forth with Mexico and Canada. And the data point they'll bring up, Ernie, is they'll say, well, Mexico and Canada, they ship out more than 20% of their GDP to the US, and that no other countries on the planet even come close to that. Is that how you see it, Ernie?
No. Canada and Mexico are our #1 export destinations. So, while certainly the United States does have leverage in a trade war with them, I would argue that Canada and Mexico are the countries with which we have the least amount of leverage because our manufacturers are the most dependent on them as customers. Remember, too, that when you, as you already mentioned before in the lead up, when one imposes a tariff, the dollar appreciates. And so that helps out consumers a little bit because it makes, imports cheaper. And so it offsets the cost of tariffs a little bit. But it ends up hurting U.S. manufacturers because it makes our exports more expensive overseas. So even if Canada and Mexico don't end up retaliating against us, the stronger dollar is going to disadvantage our exporters. And, I think it's naive to assume that Canada and Mexico won't retaliate against us. Of course they will. They have no reason not to retaliate against us. And so that will directly hurt our manufacturers, which could lead to less investment and layoffs in the manufacturing sector.
Ernie, thanks so much for your perspective on all of this as we await the official announcement and see how it plays out. Thank you.
Thanks for having me.
We're just getting started here on Market Domination. Coming up, we'll take you through some of the biggest market moves of the day and discuss where investors can put their cash with one guest calling the S&P 500 overvalued. And another guest will make the case for why the bond market might be flashing a warning signal. We'll discuss. Plus, Investor Playbook. We'll dig into how you can play the streaming space. Stay tuned. We'll be right back.
Now time for some of today's trending tickers sponsored by Tasty Trade. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, let's take a look at shares of Atlassian as it surpasses earnings estimates for the second quarter. Highest intraday level since February 2022 here. Software company reports Q2 results truly that beat, raises the full year forecast. Execs talking about strong enterprise sales execution, driving better than expected revenue across cloud and data center offerings.
Yeah, cloud and data center seem to be the two areas that investors were excited about here. And Atlassian, not necessarily like a household name, right? It's a software provider for companies. The stock's up about 24% over the past year. And Raymond James said that there was a continuation of elite cloud growth at scale and guidance above our buy-side bogeys. That suggests durability, says the team at Raymond James.
Not just cloud growth, elite cloud
Elite.
growth. Yes.
What could be better than that?
Really good.
All right, let's look at AST Space Mobile as well. That company saying it has been granted special temporary authority by the Federal Communications Commission for testing with AT&T and Verizon. Now, a little bit of context here. This is basically they compete with Starlink, is what AST Space Mobile does. So they provide connectivity to phones from satellites in places that might not otherwise have that connectivity. And so this then raises the possibility that there will be more folks who have AST Space Mobile as a provider in the United States at some point.
I saw executives quoted saying we are now accelerating our path to commercial activity, starting with testing service with off-the-shelf cellular handsets on AT&T and Verizon networks. The reports I was reading, Julie, basically means, listen, they can now, this allows their commercial satellites to provide voice and data and video capabilities, right, on AT&T and Verizon's premium low-band wireless spectrum.
Yeah, and this has been a big week for AST Space Mobile, actually. On the 29th, they announced a Vodafone contract that they're going to bring commercial satellite to mobile broadband service to customers in Europe at some point during this year. So this news today following on that news. And those shares, by the way, up a cool like 600% over the past year or so.
That's a move.
Yeah.
All right, fine. Turning to Decker's brands, those shares dropping despite a revenue beat in the third quarter. Company's outlook disappointing Wall Street. So stock under pressure today. Fiscal year revenue forecast does fall short. See some analysts saying, Julie, in response, they note the beats on gross margin, EPS, but they did call out moderation in U.S. growth.
Yeah, some moderation in growth here, but the company's still performing in some of its various business lines. Teva was the weak spot. It saw sales fall by 6% or so last quarter. I was looking at some commentary from Paul Lejuez over at Citi, who still likes the stock, although he's in neutral. He has a $215 price target. He says there was a solid beat, but he says there were high expectations and crowding perhaps into the shares, and the guidance, he said, was indeed disappointing here, and there was lack of more meaningful Hoka upside in the third quarter. In other words, it sounds like expectations were pretty high for Hoka in particular.
Yeah, KeyBank, which is overweight this name, telling the clients forecasted suggests softness relative to what they were looking for, but still optimistic, potential for upside. Even after today, by the way, that stock is still up about 50% over the past 12 months. I mean, it's been a run. All right, all three major averages given back gains less than an hour before the closing bell. The slip coming after the White House confirms tariffs against Mexico, Canada, and China will begin this weekend. Here with more is Sandy Villery, portfolio manager, Villery & Company. Sandy, it's great to have you on the show. So let's start there with tariffs. Sandy, I was talking to Julie at the top of the show how starting today, it almost felt like investors were kind of looking through tariffs, or maybe thought they wouldn't come, or if they did come, it would be as bold as the rhetoric was suggesting. But the headlines keep coming, Sandy. So as a market strategist, how are you thinking through this?
Yeah, no, here we are, right? So looking at 25% in Mexico and Canada and 10% in China. And at the end of the day, you look at what the Fed was saying this week, they're very nervous about inflation. These things are going to be inflationary. In our mind, we buy, domestic sort of smaller mid-cap companies. And so we do think the dollar is going to be a little bit stronger. We think it's going to be tough on larger multinationals. And so we really like our domestic small caps with a stronger dollar and protectionism in play.
But boy, Sandy, if those small domestic companies are manufacturers and they're making anything made of stuff that's imported, that's not going to necessarily be great news for them, is it?
Yeah, well, I think you got to be very specific about the companies, but you're exactly right. I mean, everything with a stronger dollar, that is definitely going to make things, more expensive for everybody else. So I do like, a handful of companies that again are company specific that I think will do well and ride through this turbulence of what we've got going on with the new tariffs.
Broad strokes, Sandy, how does valuation look for those small caps here?
Yeah, so I mean, when you look back over the last 10 years, we've got small cap has really underperformed large. When you look at value versus growth, I was just looking today at Vanguard growth versus Vanguard value. It's like 16% annualized for growth and 11% for value. So that's a lot of it's a big kind of historical spread between small and large and growth and value. So we want to be a little bit more defensive and buy what's cheap. And so we're avoiding the larger cap, very expensive technology stocks. And we didn't know that DeepSeek was going to come out of nowhere, and all of a sudden NVIDIA, goes down 17%. But when things are priced for perfection, it gets to be a challenge. And when I look at the S&P, going back even 80 years, 1999, 2021, and now today are the most expensive multiples on forward earnings that we've really seen. So I'm pretty skeptical on large cap in general.
So let's talk about some of your small cap picks here. And I do notice that maybe they avoid some of the pitfalls that we were just talking about in terms of the knock from the stronger dollar. I mean, take Option Care as one of the stocks you like that provides infusion and home health care. And obviously that's not something that, that's something that is sort of encapsulated domestically, I guess.
That's exactly right. I mean, I believe that people are going to continue to get their home infusion therapies at home or in a clinic, as we're really what they offer. This company in particular had a tough third quarter because they were exposed to the hurricane in North Carolina. That's where all the saline bags were being manufactured from. So they had a little bit of a hiccup and the stock sold off. And then, they just reported fourth quarter and, they've got that under control and it appears to be an anomaly. They also lost a drug called Stelara, manufactured by Johnson & Johnson that will hit them a little bit on profits. But management was able to basically explain exactly what that's going to cost, maybe $60 million in profits. And so now people can sharpen their pencil and say, this is cheap. So we like Option Care and think it's a very consistent business.
Sandy, what about Atlas Energy? It's up about 30% over the past 12 months. What are the catalysts that drive this one higher?
Yeah, so today's interesting because this is a sand company, a sand mining company. They just built a 42-mile conveyor belt system in the Permian Basin, which is where they really are. They can now get sand cheaper to all of their customers that need it for fracking and horizontal drilling and that sort of thing. So today they just priced 11.5 million shares at 23, which is why there's pressure on it right now. But this is going to close on Monday. And they just made a great acquisition of a company called Moser, which gets them in the power distribution business. So 900 natural gas powered generators with about 212 megawatts of power that their customers need. And it gets them into other basins, the Bakken and the Eagle Ford. So we think this is a very different company. It's going to go from being a sand company to more of a logistics company and full service energy solutions provider. So we think today's a good opportunity to buy it when they sold some stock to raise some money.
And then also one of your other picks is Ligand Pharmaceuticals, I think is how you say it, Ligand Pharmaceuticals. So it's a royalty company within the pharmaceutical space. So why do you like this one? I guess here too, sort of minimizing exposure to policy risk.
That's exactly right. So when you think about making a biotech investment, it can be a binary outcome. You can FDA approval, you cannot, that sort of thing. But what's nice about Ligand is that they have many different shots on goal. So they've essentially got 12 scientists that are making, right now they're involved in 100 different partnerships and programs. They invested about $192 million last year. And the goal is to ultimately just be a royalty company and just collect royalties. So it's a neat business. We think it really is not exposed to things like tariffs and other issues going on, and one that we think will do quite well. And it's just about a $2 billion market cap. So we think there's a lot of room to run.
Sandy, good to see you. Thanks so much.
Thanks, Julie. Have a nice weekend.
You too. Programming note here, on Monday, we're airing an exciting interview with Microsoft founder Bill Gates. He joined Brian Sozzi on our podcast Opening Bid. He talked about everything from his new book, Source Code, to his take on the future of tech. Here's a little teaser from that interview in which Gates addresses NVIDIA CEO Jensen Huang's comments that quantum computing has decades to go.
Jensen's correct. It could take longer. This is both in terms of how you build a quantum computer and what software you write that can solve problems that other computers couldn't write. There's some hard work to be done.
Don't miss Opening Bid. That's airing Mondays, Wednesdays, and Fridays at 8:30 a.m. Eastern on Yahoo Finance or wherever you get your podcasts.
Coming up, we're dissecting moves in the bond market, and one expert tells us why some of the action may be flashing a warning sign to investors. Stay tuned for that.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Let's get to some calls of the day. Right now, JP Morgan is initiating coverage on oddity with an overweight. The note highlighting the company's strong financial performance in 2024 also highlights that it's going to be introducing some new brands in 2025. This is the maker of and owner of Il Makiage and Spoiled Child, which are two beauty and skincare brands. Oddity says that its sort of differentiating factor is product discovery through AI. So it's interesting to see JP Morgan highlight this particular stock.
Yeah, they tell their clients well-positioned for sustained 20% growth as the beauty industry, they say, shifts online. They say Oddity has exceeded its financial outlook each quarter since its IPO, but beauty industry concerned, they've been an overhang. We think this creates an attractive entry point, Julie.
Yeah, and speaking of its IPO, by the way, that was in 2023 in July at $35 a share. The stock kind of surged after the IPO, then came down. But as you can see over the past year, it's had pretty strong performance.
They also talk about Oddity lacking exposure to China, trading at a discount to beauty and DTC peers, despite best-in-class growth and profit, Julie. Gold futures, meanwhile, touching new records before moving lower as traders weigh that threat from tariffs. Goldman Sachs reiterating their bullish stance, saying it sees value in long gold. Yahoo Finance's Inez Ferre joins us now with more. Inez.
Yeah, Josh, Goldman Sachs saying go long gold with U.S. policy uncertainty in the scenario of tariff escalation. This reinforces that role of diversifying commodities in portfolios. Their top commodity pick is the yellow precious metal. Just to back up for a second, we are seeing that gold year to date is up 6%. Last year, we saw gold that was up 27% for the year, outperforming the S&P 500 last year. And this is because of what traders have called structural changes to the market. Central banks buying a lot more gold and greater flows into the physical backed gold ETFs. So after a lull over the summer last year, you saw that there was a big pickup in central gold buying in the fourth quarter of last year, and that was driven by the People's Bank of China. Now, why would tariff talk or the prospect of a tariff war send prices higher? That's because tariffs are very protectionist, and gold is also a protectionist safe haven. As central banks hoard more of it, more gold, perhaps they're trying to get away from the US dollar, you see prices going higher. I do also want to point out something else that's been happening recently in the physical markets. More shipments of gold from London to the US for fear that tariffs would increase the cost of gold imports. So the Bank of England usually holds the UK reserves. They also are a holder for commercial gold that's owned by banks and central banks around the world. So we have reports that large quantities of gold has been shipped here to the US, to the COMEX vault in New York, depleting London's reserve, delaying withdrawals over there. There's also an interesting arbitrage that is going on, and that is that the futures market in New York for gold has been higher than the spot market in London. So you have that arbitrage also increasing shipments here to the US, guys.
All right, thank you, Inez.
Thank you.
Treasury yields lifted by the Fed's preferred inflation gauge coming in line with expectations while investors brace for a looming Trump tariff deadline as the second Trump presidency kicks into full swing. Our next guest says the bond market is sending a warning sign. Bridgewater Associates former chief investment strategist Rebecca Patterson joins us now to discuss. Rebecca, it is great to see you. I want to get to your op-ed, Rebecca, but listen, I also want to get your take just on the subject of today. It's tariffs. Headlines coming fast and furious. I think there's a lot of folks wondering, Rebecca, what it means for them, their portfolios, how they're positioned. As a longtime market pro, how are you thinking through this?
Despite the headlines today on tariffs, I think we won't know anything till we actually see the headline that they've been implemented. And even then, I think it's all a question mark. Are they tariffs that are phased in? Do we start large and then phase out if certain conditions are met? So I don't think we know yet how big they're going to be, how persistent they're going to be, if there will be exclusions for certain things. In Canada, for example, we certainly would be shooting ourselves in the foot if we're putting big tariffs on energy that we import from them. So I still have a lot of questions, but I think to me, the most important thing right now is we now have lived with 2 weeks of this new world order, which is going to be a lot of intraday and short-term volatility, questions around policy. And that matters because over time, if companies are less certain about what the rules of the road are, they're going to be more cautious about hiring and investment. And if consumers are more cautious, they might slow spending. And so those two things together can actually, over time, not immediately, but over the coming quarters, weigh on GDP, at least at the margin. So the uncertainty matters. Not knowing what the rules of the road are going to be from day to day has an effect.
And Rebecca, do you think that nervousness is also showing up in the market? Not necessarily in volatility, but in terms of price movement in any segments?
I absolutely think that the volatility in policy that we're seeing right now, the uncertainty in policy, is rippling through the markets. I think that is one of the reasons we're seeing gold prices continuing to rise this year, even after huge gains last year. I think it's another reason that we're seeing bond yields up a little bit today, which gets to my recent piece in the New York Times a little bit. The rise we're seeing in the longer term yields is what they call term premium. It's the extra that investors want to loan the government money for longer. And some of that has to do with policy uncertainty. Do we have a huge increase in supply of bonds on the back of new tax cuts? Do we have higher inflation on the back of tariffs? Even if we don't know what the outcomes yet are, the fact that we have this greater uncertainty gets reflected in term premium, which is a component that pushes up the overall 10-year government yield.
How much, Rebecca, is uncertainty, but then also how much you think is another factor, the economic data frequently coming in better than expected?
It's a great point. So term premia, it's such a wonky thing. Usually it's, my fixed income friends and central bank friends who focus on this, but I think it is important for everyone to understand this is a catch-all that's just how much extra you get for a long-term bond versus very short-term fixed income or Fed funds. And it can reflect good things. It can reflect a lot of benign things, to your point, like better expectations for growth. If the Trump administration does a lot of deregulation and that helps growth and it helps animal spirits, you could see higher bond yields and higher equity markets. And that's exactly what we saw from September to mid-November last year. However, the term premium can reflect less benign things like increased bond supply, maybe with not enough buyers, or inflation uncertainty. That's what we saw in the third quarter of 2023. We had rising term premium, rising yields, and the stock market in that quarter fell about 3.5%. And it was at a time when, remember, Treasury Secretary Yellen was saying, we've got to increase bond supply more than expected. And we had a credit rating downgrade of the U.S. sovereign credit. So again, what drives the term premium can be benign or less benign. If it's less benign, that's the big risk for households and companies, because then your yield is going up. So your bonds prices are falling. And the stock market tends to be falling on the back of those same concerns. So if you're in a 401k with a 60-40 equity bond mix, nothing is working for you. You don't get that diversification benefit. That's the scenario I'm worrying about.
Well, and Rebecca, whether the reasons are benign or not benign, I can think of one pretty obvious pressure point that comes from higher yields, and that's mortgage rates, right? Where we've already seen a lot of stress in the housing market. And it looks like there's not a lot of relief in sight because of the dynamics you're talking about.
Absolutely. In a best case outcome this year, bond yields probably, and I'm talking about longer terms, so like a 10-year Treasury bond yield is somewhere in a range around current levels, around 4.5%. And if it just stays there, you can still make money on your bonds from that interest rate. So that is your good scenario. But to your point, even if we have a steady bond yield over the course of this year without a lot of volatility for auto loans, for home loans, this is going to be a drag. And just for companies looking to borrow, other markets price off the 10-year. And so at the margin, it is going to be something that slows the economy. And we heard Chairman Powell from the Fed just this week at the latest FOMC meeting discuss this. He highlighted term premium specifically as something that helped him understand that monetary policy remains restrictive. So you're right, even if it's a benign scenario lifting the yield, it still can have some limiting influences on growth.
What do you think, as we sit here, Rebecca, as investors, our best hope is, bottom line when it comes to tariffs, deficits, deregulation?
I mean, realistically, given this administration, what it campaigned on, I think that the best reasonable case is going to be tariffs that are very targeted and used more as a negotiation tactic than anything. fiscal policy that eases, but again, more marginally, and that there's some pay-fors for the fiscal stimulus, that we don't see a huge increase in our budget deficit. Right now, the Congressional Budget Office is saying our budget deficit could grow to $2.7 trillion by 2035. We'd like to see that a little bit smaller, ideally. It's not clear to me the fine the pay-fors, but targeted tariffs, limited fiscal spending overall, net fiscal impulse, and some really positive benefits from deregulation. To me, that would be the best case, and we might get it. We might get it. I'm not judging. I'm just saying these are the things I'd want to see to line up, so I don't have to be so gloom and doom.
Yeah, I don't know if the early indications are quite yet clearing in that direction, Rebecca.
Not yet, and that's why I think, to your earlier segment on gold, if you want diversification in a portfolio today, and there's a risk that bonds don't play the role you want, looking for other ways to diversify, whether that's alternative assets, maybe hedge funds, and things like gold, can provide some of that diversification. One thing that doesn't, and I just want to get this on the record because I hear so much misinformation, is Bitcoin. Bitcoin has made amazing gains, and kudos to people who bought it before the election. But you can see just this week, when tech goes down, fintech goes down, Bitcoin goes down. So for diversification, I would look more to alternatives, to gold, maybe short duration bonds, not necessarily crypto.
Interesting. Good point to make. Rebecca, thank you so much. Appreciate it.
My pleasure. Thanks.
Coming up, your investor playbook, we discuss how to best play the entertainment sector. We'll zero in on a few familiar names. More on that after the break.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Just days before the 2024 election, Donald Trump filed a $10 billion lawsuit against CBS, accusing that network of deceptively editing an interview with then Vice President Kamala Harris on 60 Minutes. At the time, many dismissed the case as a long shot, but times have changed. Donald Trump is back in the White House, and a new report says parent company Paramount is considering settling the lawsuit in an effort to ensure its multi-billion-dollar merger with Skydance goes through without interference from the White House. Joining us now to help us understand how to navigate a rapidly changing media landscape is Robert Fishman, MoffettNathanson Senior Analyst. Robert, it's great to see you. So you say, Robert, the themes of 2025 in this sector, they could very well mirror the themes we saw in 2024, and you told your clients that is a problem. How come, Robert? What do you mean by that?
Well, what we're saying is really that the underlying state of the business on the linear television side continues to be a challenge. And that's where still a lot of these traditional media companies are getting the majority of their cash flow. So the more pressure that continues to build in terms of the weakness on linear television advertising and cord cutting, that's going to continue to force different hands here. And where that's going to ultimately lead, we think, is probably more consolidation at hand.
And how friendly is this administration going to be to consolidation? And are we going to have to see more maybe settlements like this Paramount settlement or like the ABC settlement that we recently saw as the industry maybe tries to tip the scales to get some favorable attention?
Yeah, I mean, it's a really good question and an interesting one because it is complicated given the ownership of the assets and these linear networks that exist within these portfolios. So we're not saying here that it's a slam dunk for any of these guys to come together. Clearly, there's complications depending on which asset we're talking about or which company we're talking about. But at the same time, these companies are going to be forced to go down that direction the more that the pressure builds. So really, ultimately, it's going to be the fundamentals that drive the decision, not just the need for consolidation for any other reason.
Let's get to some names, Robert, in your universe. You recently upgraded WBD to buy. How come? It sounds like in part your thesis there was you do think this is one of those names that, as you point out, could keep M&A bankers kind of busy.
Yeah, I mean, listen, that's clearly a potential growing realistic option here. But the flip side of the whole upgrade is also from a fundamental reason. And what do I mean by that? Basically, the company has had challenges. That's evident from the stock reaction over the past year. But at the same time, we think that the fundamentals are positioned for more stability going forward at the very least, if not improvement, in that the big change that happened at this company was losing the NBA rights. And I think there was a very reasonable expectation that would have a negative impact on their future negotiations with their distributors. But in fact, they got their deals done with Charter, with Comcast, and likely with others. So that gives some sort of at least downside risk protection when thinking about, back to the first question, what that fundamental linear cash flow is going to look like from the television networks that they have at Turner. So once the NBA was essentially resolved, probably much better than most feared, then we have increasing confidence that we can get some higher conviction, at least, on where the trajectory of these cash flows are going to go. And we don't think that that's properly discounted in the share price today, given the leverage and deleveraging that should happen with that cash flow.
Interesting. You're buy rated now on that one. I think the only other media name that you're buy rated now on is Disney. WBD doesn't report till the end of February, but we're going to hear from Disney before that. What do you think we're going to hear? What are you looking for from them to continue to justify that buy rating?
Yeah, I mean, Disney gave us a lot of information on the last earnings call in terms of thinking about where this company is going, laying out a lot of very specific guidance by different segments. And we think what that did is lay out the vision in terms of where the company ultimately wants to go and the earnings power that they see along with that journey. So really, the next thing that we're looking for is how they're going to start to execute against that guidance. Clearly, that's short-term in nature if just talking about the quarter, but really the confidence that investors need to deliver that double-digit EPS growth for 26 and 27, that's really critical here. And what it comes down to is ultimately the confidence in the DTC profitability ramp and stability, at the very least, if not continued growth at the parks.
Finally, Robert, Netflix, why is that a neutral? And what would it take to get you more bullish?
Well, they've clearly far exceeded our wildest expectations in terms of the fundamentals. So you got to give the company a lot of credit for that over the past year. The question that we have to struggle with is really where to from here. So once you start to think about where the growth profile is and where it's currently valued, that keeps us on the sidelines right now. But it's clearly a company that's operating on all cylinders. They get a lot of credit, and deservedly so, where they are today. The struggle that us and investors need to have right now is how much more room is there to the upside from here. So that's kept us on the sidelines right now. But again, the company continues to perform exceptionally well.
Robert, always good to have you on the show. Thanks for your time and those picks. Appreciate it.
Thank you.
While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
That's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's trade. Let's check on the major averages first of all. The Dow lower by 337 points or so, about 0.75%, and really closing at the lows of the day here. As we've been talking about, there were some whipsaw headlines about whether indeed tariffs are going to go into effect tomorrow on Canada and Mexico, in particular, 25% tariffs. There was a report earlier in the session from Reuters that they were being pushed back to March 1st. Then the White House pushed back and said, no, that's not the case. They're going into effect tomorrow. And then President Trump continues to speak about what may be tariffed in terms of some of the products that may be affected. So the Dow closing at the lows of the session, the S&P 500 closing at the lows of the session, off by 0.5%, and the Nasdaq Composite closing down 0.25%. And we earlier talked to Rebecca Patterson, former CIO at Bridgewater Associates, and she talked a lot about how much we still do not know. Even if we find out with certainty that the tariffs are implemented, then they get implemented, it is still difficult to know for certain what the effects will be on corporations and on the U.S. economy. As she pointed out, there is a concern that consumers and corporations will hold back on spending because of all of that uncertainty. Jared's got a closer look at today's action. Hey, Jared.
Hey, Julie, indeed, there's a lot of uncertainty and certainty. And we see this in the market today. And by the way, late day volatility is back. This is something we saw yesterday. We saw a steep decline, then a rebound. Today's action in prices was much more of a steady decline in the afternoon hour, but this was the norm 4 to 8 years ago. And so we just need to keep that in mind. U.S. dollar index was up again. We did have some volatility intraday. This is only 0.5% that we're talking about in terms of the range of the U.S. dollar today. It's not huge, but it is significant that this is happening outside of the Europe close. In other words, not most of the world is, rest of the world is open this afternoon, and that's where we're seeing these movements in. So here's the sector action. We are not without green today. We see XLC, which, by the way, closed at a record high. So did Meta, so did Alphabet, two of its biggest components. We'll look at those in a second. Energy taking the biggest hit here. That was down 2.75%. Staples also down nearly 1%, and kind of a sea of red in a lot of areas. If you take a look at the Nasdaq, though, you do see a lot of green. Nvidia down 3.5%, Apple down 0.2%, but for the most part, we're seeing some decent amounts of green despite the down days, the down day in the indices. Here we can see Alphabet up 1.5%, Amazon up 1%, Broadcom up 2.6%. And let's get a look at unprofitable tech. Outside of Tesla, which is profitable, by the way, this is a disruption area, we are seeing a lot of red. So the smaller tech names, some of those under pressure today, Josh.
Thank you, Jared. Tough day on Wall Street. Stocks sliding midday as the White House reiterated that tariffs on Canada and Mexico will go into effect on February 1st. Joining us now is Chris Bardo, Forward Pitt Capital Group Senior Investment Analyst. Chris, it is good to see you. So let's start there with tariffs. Just curious how you're thinking about this as a market strategist, Chris. You know, we had another market pro on the show earlier, and she said there's, you know, beyond the headlines, there's just too many questions still about how big, how persistent, exclusions. But walk us through what you're thinking on it.
Yeah, definitely. Thank you for having me again. And I kind of want to point out the thing with tariffs is we all know how they impact the consumers at the end of the day. And we already went through round one of a Trump presidency, and we saw how tariffs and the China trade kind of affected the day-to-day prices and a lot of the underlying securities in the market. Although over the longer term, the trend still ended up to the upside. So we think that right now, between tariffs, the 25% on Canada, Mexico, and then 10% on China, we think that this could have slight issue in terms of earnings estimates for this year. I mean, we are looking at around 16% earnings growth this year and then a low 13 next year. So during this earnings season, we're going to be looking for guidance on the call and the impact that these tariffs are going to potentially have on their bottom line and operating margins.
Well, and a lot of companies have been talking about them already. They're getting a lot of questions about them, and depending on the company, it is having a bigger or smaller effect. I was going through some of the conference calls on this point. You have a company like Weyerhaeuser that makes, you know, corrugated cardboard, paper, lumber imports from Canada could end up being an issue. But again, there's still so much uncertainty about the actual effect. So do you, as an investor, also want to hold off on making certain bets until we know more?
So as an individual equity investor, we kind of look at a bottom-up approach, and we're investing in individual businesses. So for instance, a company like Microsoft is relatively insulated from most of the tariff talk, even though they kind of have half of their revenues internationally. Foreign exchange is one of the biggest issues that they would probably run into. Whereas we also own companies like GXO and Lululemon or Keysight Technologies, where the tariffs won't hurt them as much. So I think you have to be very selective in the equity markets in terms of where you want to be invested, as we kind of channel through these different quotes coming out of the White House.
So Chris, you mentioned Microsoft. That's interesting. Listen, they reported, and they got whacked, Chris. You know, it was that Azure shortfall that clearly spooked some investors. Was that a buying opportunity in your opinion?
So yes, we do think it's a buying opportunity. We are long Microsoft. We have been for a very long time now, and the company is essentially investing to meet the longer-term demand of the cloud computing. And you're seeing that in the numbers from NVIDIA. You're seeing it in the numbers from the semiconductor equipment manufacturers. We think that estimating Azure on a quarter-to-quarter basis, it's kind of a little finicky. It was around 31%, slightly below street estimates, and we kind of think that'll hockey stick into the end of the year, into 2026. They noted that they're expecting double-digit revenue growth, operating income growth in fiscal 2025, and they've given us some good insights into their CapEx trends. We think that'll start to normalize. They gave us a little more color there, so it's slightly easier to model over the next 5 years, but yeah, we definitely view Microsoft as a buying opportunity here on the JIP drop.
Another one of the stocks that you like is Lam Research, which is really interesting. This is a chip equipment maker. Obviously, this was a turbulent week for chip makers. How do you think DeepSeek, something like that, affects Lam, if at all?
So in terms of DeepSeek's effect on Lam Research, we don't think it has too much of an effect. Lam Research's main customers are the Samsung and the Micron type of companies that are more levered towards memory, DRAM, and NAND. And we like the fact that Lam has consistently been ahead of the curve in terms of technology. Capital allocation-wise, they are focused on returning 75 to 100% of free cash flow to shareholders. So in our opinion, that's extremely valuable when we're investing or buying shares in a company. I think in the most recent fiscal year, they might have returned around 98, 99% of their free cash flows through dividends and buybacks. So as an investor, we like that attractiveness for allocating client capital.
Chris, always good to see you. Appreciate it. Thank you.
Of course. Thank you.
All right, let's check in now on two top trenders on Yahoo Finance, how they closed today. That's Chevron, Exxon. They both closed lower after reporting earnings results. They saw steep declines in refining profits as a result of lower fuel margins. And now President Trump has confirmed he will put tariffs on oil and gas by February 18th, Julie.
Exactly. So margins on this stuff for the oil producers were already kind of tight. And just for folks, just a little bit of background here. When we're talking about the oil giants in the United States, they both get oil out of the ground or out of the sea or wherever they're getting it out of. And then they also change it into other stuff. They change it into gasoline, into heating oil, plastics, for example. And the margins on changing one thing into other stuff were not great in this quarter. And they saw the refining profits fall. Now, that is why there's so much attention on these tariffs from Canada. I saw one stat today that Midwest U.S. refining operations get up to 3/4 of their feedstock, in other words, the raw material oil that they're making into other stuff, from Canada. And so if there are tariffs, that's going to be another input cost pressure on these oil giants. We did get some more headlines on oil in the last hour from President Trump saying that he expects oil and gas tariffs by February 18th, but over time he might reduce the tariffs on oil to 10% from 25% from Canada.
Yeah, it's just because, of course, Trump campaigned as a friend of big oil and gas. You still see these companies. I thought it was interesting to read about Chevron referring to the Gulf of America instead of Gulf of Mexico. So you see companies across a range of industries and sectors trying to stay, I think, on Trump's good side.
Well, and Chevron also talked about increasing its production, right? So that's something also that Trump wants to hear. But none of these companies want to increase that production if it's not going to be profitable.
Right, which is a common theme when I think we've asked every energy
Yes.
analyst and strategist that exact question.
Yes, so it's a fine line that they are trying to tread here, both politically and for their profits. So we'll continue to watch the headlines. I'm sure we'll get many more of them. Well, Donald Trump ran for president in 2024, promising to get prices down and end the runaway inflation that swamped Joe Biden's presidency. Now that he's in office, however, Trump is grappling with the same inflation two-step that left Biden puzzled. Joining us now, Yahoo Finance's Rick Newman. He's trying to address it, but there are other things that affect inflation, of course, as we know.
Right, and this is before we even get to any effect that tariffs and deporting migrant workers might have. We're seeing inflation we almost fixed it last fall, but now it's ticking up. We got, if you look at the PCE deflator, which the Fed likes to look at, that has actually been ticking upward, not downward, for the last 3 months. And as we know, of course, this week, the Fed said, well, maybe we don't need to cut rates anymore. They're a little more concerned about inflation than they were in December. And all indications point to Donald Trump as one of the things that the Fed and many other market watchers are keeping their eye on. And we're just getting reinforcements of that today with Trump saying, he's basically saying, yeah, forget about lowering prices. I'm gonna put these tariffs on imports from Canada and Mexico and maybe China and oil and gas and so forth. Now, I think we have to keep in mind with regard to these tariffs, I mean, the market hates this. We saw a little sell-off today, but Trump threatens these things, but that doesn't automatically mean he's going to do it. He's trying to get something in negotiations from these countries. So far, the thing that he has singled out is not what he talked about during his first presidential term, which was lowering the trade deficit, but he wants help reducing fentanyl imports to the United States. So even though Trump is saying these tariffs are going to go into effect starting tomorrow, I think there's still some room for Canada and Mexico and others to avoid these tariffs by saying, okay, we're going to make some agreement with Trump and we're going to put them off for now or see how long we can get, wriggle out from under them. But nonetheless, markets are more concerned about inflation than they were in the last month of the Biden administration.
Well, and Rick, I got a little bit of an inflation curveball question for you. It has to do with eggs. As we know, egg prices are going up again because of nothing to do with anything except avian flu, it seems, right? And so, I don't know if you've been to the grocery store and tried to buy eggs lately. If you can even get them, the prices are higher. And I have to wonder, politically, is that going to be an issue for Trump after he campaigned so heavily on bringing inflation down?
Democrats sure hope so. I'll tell you what, I haven't noticed egg shortages in my grocery store, but maybe that's coming. I was in Utah last week, however, and there were hardly any eggs in the case. And there were signs that saying, we're having a hard time getting eggs, and they were $10 a dozen at Target. So this is definitely a problem somewhere. Now, one of my favorite things that happened this week is Senator Elizabeth Warren, the Democrat from Massachusetts. She put out a statement saying how outraged she is about egg prices, and Donald Trump needs to do something about this. Now, egg prices surged under President Biden, and I don't remember Senator Warren saying how outraged she was about egg prices when Biden was president, but now that Trump is there, she's outraged. All of this, all these statements from politicians in their press conferences and dueling press conferences and statements and claims, this doesn't really impact voters very much. What impacts them for sure, look, people know what stuff costs, and when they see this happening at the grocery store, yes, it's going to be a problem. So, on this topic, we have seen in consumer confidence surveys, consumers do expect higher inflation during the next 12 months, and they are connecting that with Trump tariffs. So people are getting the message. And if this actually follows through to increases in prices for products on shelves that people are buying today, yes, that's going to hit Donald Trump, and he's going to end up with the same inflation problem Joe Biden had.
All right, Rick, always great to see you and have you on the show. Have a great weekend.
Thanks for the curveball.
We'll be right back.
Interest in options trading at the retail level is growing, yet 77% of traders cited a lack of knowledge about options as a reason to stay away from the market. That's according to a survey from Moomoo. So what do beginner traders like to know? What do they need to know? Moomoo CEO Neil McDonald's joining us in studio to help break it all down in the Options Playbook, sponsored by Tasty Trade. Moomoo is an options trading platform, so who better than to answer some of these questions? So I'm going to just fire a match at some of these common questions that people have about options trading. Which strategies are best for beginners?
I think for beginners, it's start small. So we have on our app, we have paper trading. So you can play with pretend money, and that's a good place to start. But as start small, single legs, just calls and puts, overwriting your portfolio, nothing too complicated. But I think there's never been a better time to be an options retail trader.
Why?
Retail traders generally have always the market's really been against them, right? They didn't have the information until the internet and Yahoo Finance came out, and then all of a sudden they had the information. Then they didn't have the community, right? They're trading in their bedrooms or in their basements or in their garages. So things like Wall Street Bet, and then we have 24 million people on our community. So you can send out trading ideas, and human beings generally are not very good at trading, right? We're not that far removed from running away from saber-toothed tigers and stuff, and it's a very emotional thing. So retail traders tend to take profits too quickly and tend to run losses, right? So with a community of people, and you saw that in the crypto community with HODL and stuff, and with GameStop and others, you can actually put your ideas out there, and it's kind of, I see it as community or communal risk discipline. And then on top of that, you now have the tools, right? So I ran a quantitative trading desk at a hedge fund, and the tools we had 10, 12 years ago, because of chips in the phone, because of just financial technology generally, and cloud computing means on our app or on our desktop, you can do no-code algo building. You can do, we've got option strategy builders. So you can say, I'm bearish, I'm bullish, I'm neutral, and it will build the strategy for you. And then there's the crazy stuff. You can back test it on 10 years worth of data. So basically, what a quant trader at a hedge fund had 10, 12 years ago is available to the retail investor right now.
What, for viewers right now, maybe they're beginners, what's a good amount to start options trading?
I would start with zero for the paper trading. I'd use that facility, and play with play money. But then you have to have, to have an options account, you need to have at least $2,000. You have to have a margin account at Moomoo. So that's a general FINRA rule. So always start small. So if you think about it, if you're insuring your portfolio, right? If it's a hedging trade, think about the size of your portfolio. Is it $10,000? Is it $100,000? Or and then look at how much it would cost to, if you need to hedge out all of the risk or 50% of the risk. It's generally a small insurance premium you're paying for buying puts. If you're buying calls and buying stuff outright, then it's really what you can afford to lose, right? Because it's not stock trading, right? They do expire. And it's difficult for people with options to begin with. I think human beings, the thought process is very linear. I think we all think in a very linear fashion. But the payoffs in options are exponential, right? They're not linear. So it takes a while to understand. And so some of the tools we have that show what the payoffs would look like, kind of visualizing those the payoffs helps you as a human being understand what your risks are and understand what the possible payoffs are.
And one other question that people commonly have, is it riskier to buy or sell options?
It's risky to sell options.
Yeah.
It depends. Selling covered calls is not risky if you're happy for the stock to get called away if it's in the money at expiration. But selling puts, your downside is the whole price of the stock. Selling calls, naked or uncovered, it's unlimited loss.
Right.
Right. So we have four levels of option trader, and the beginners are only allowed to trade level 1, which is safe, just buying calls, buying puts.
Trading wheels.
Trading wheels. And then when you get up to level 4, and that shows you've been trading for a while, you're sophisticated, you have a larger AUM, then you're allowed to take riskier strategies. But I'd say we did a whole survey of our clients, and 2/3 of them have been trading options only in the last 3 years.
Oh, wow.
And more than half of them use them for yield enhancement, so call overwriting and then put protection. So we don't see a huge amount of speculative activity in our options. Obviously, we don't allow beginners to sell naked calls or do really daft stuff.
Do anything, daft stuff.
Daft stuff, yeah.
Neil, thank you so much. Really helpful stuff for people. Appreciate it.
No worries. And we got, I was going to mention Snap. I've been looking at Snap for next week.
Yeah.
Which is an interesting options book right now. So the stock's been between 10.5 and 13 since the big sell-off with the Q2 earnings last year. Earnings are on Tuesday. The market is expecting large moves. And if I look at the skew, which is the difference between the out-the-money calls and the out-the-money puts, the market's expecting any surprise will be to the upside. So looking at the big open interest is the 13 calls.
Well, we'll see what happens if it's not to the upside. Neil, thanks again. Appreciate your time.
Thank you.
The automakers in focus this week as tariffs loom over the industry. In part two, Paras Subramanian's interview with Ford CEO Jim Farley. He also got his take on the automakers' performance business.
Let's talk performance, right? Sure. You know, even with EVs, you have the Mustang Mach-E Rally. You got the Rally, which is a really fun and interesting car. But out here, it's Mustang, it's Bronco, it's Raptor. What is the importance of these brands, these halo products, to the Ford brand itself?
Well, first of all, it's huge business. I mean, our off-road business alone is a huge percentage of our global profit, and it's growing fast. People really love not just off-road products, but enthusiast off-road products like Raptor. So these brands, this business is a vital part of our revenue, our profit, but also our brand image. And that's really important. We really believe that Ford, when it's at its best, is a great commercial brand and a great enthusiast product brand. And that could be a pickup truck, it could be a van, it could be anything, electric, partially electric. We think that's where our brand should be.
And kind of going forward, do you see that performance brand, the performance brands actually growing in business year over year and things like that?
Yes, we're heavily investing in racing. We're going Formula One next year. We're basically in all off-road racing from Dakar and Saudi and the desert to Baja, King of the Hammers. We're in pretty much every off-road venue you can find, racing every weekend. And that allows us to bring technology into the product that people can buy, like the Raptor R, or the Raptor series, or the Mustang GTD, or the Dark Horse, or the Dark Horse R. All of those are because we race. And this is really important because it's also a prideful thing about our company. We have an indigenous sport in our industry called racing, and we're lucky to have it. And there's a lot of enthusiasm from the employees as well, and our stakeholders like dealers and suppliers who want to be part of winning. We just won at Daytona. 24-hour race with a Mustang, we won by 2 seconds. You know, that is so exciting for our team.
I was going to bring that up. Congrats on the win, by the way.
Thank
I know
you.
only the second year with that
Yes.
car now. So, you know, you mentioned racing. That's part of the DNA of Ford. How do you make that sustainable, right? You're talking about racing sports cars, but then also F1, right?
Great question. Well, the first thing is you need to have road cars and trucks and vans that are tied to your racing. And your racing makes those better. That's really important. Second thing is technology transfer. Formula One's a good example. What we're going to learn from Formula One is aerodynamics, predictive failure software that we can give our pro customers. Like a lot of it is technology, software, and display for Formula One. And then, of course, it's a great parts business. And most of all, it's great for our brand. People really, like we won the NASCAR championship last year with Joey Logano, 3 years in a row. I mean, people buy trucks who are here at Charlotte watching us race. You know, that drives our business. So it's great for our company.
So I believe your background is in marketing and sales and things like that. How does the F1 experience, the F1 sort of branding with Ford, how does that work? How do you make that, how do you sell that from a marketing point of view?
Well, I think at Ford, we kind of made the decision to not look at racing as a marketing cost. We want to look at it as a product development, advanced product development, and also technology transfer, and the transfer onto our enthusiast products on the road. That's what makes companies like Porsche or Ford really special. They take what you race and they put it, and you can buy it in a production vehicle. I think and to be sustainable, we need to focus more on customer racing. Instead of the company always racing, selling race cars to other people. We've learned a lot, done a lot of benchmarking, companies like Porsche, and they have a sustainable business model for racing. They don't have to write a big check for marketing because it's a profit center.
So you're in the Mustang Challenge. I see that
Yes.
logo on your race suit. I drove in the Dark Horse R, amazing vehicle, but that's for sale to people that want to get into racing,
Yes.
you know, at a little bit of a higher level, but not that high.
Yes.
Is that a business that can make money?
Yes. Right now we put about 20,000 people through all of our driving schools around the country, around the world. We have Bronco off-road rodeos as an experience. People pay to go do that. So yes, it's a profitable business. When you tie it to production vehicles, when you tie it to racing as a business, racing is a huge business. Go to the racing convention in Indianapolis. It is a huge business. And we've looked at it more as write a check, you know, win on the track, sell on Monday morning. That's not the paradigm we're looking at racing anymore.
It's not about selling Monday morning. It's about just the flywheel effect of everything tied to motorsport.
Perfectly said.
Last question. I want to read something that you told me last year, and I want to get your response to it. You said, quote, last year we were here in Charlotte. To bring a Mustang back to Le Mans and beat Porsche and Ferrari at home on their turf in Europe, not with a GT prototype or a one-off car, but an American car that someone could buy for 30 grand, how cool would that be to beat Ferrari and Porsche? Well, you did do that on American soil,
Yeah, we
right?
did.
You did beat Porsche and Ferrari on American soil. Is Le Mans next?
Yeah, we finished third last year, and you know, third is kind of the third loser. So no, we're going there to win. I'll be there. Bill will be there. We're actually bringing the Mustang Challenge there. We're going to bring 30 to 50 Mustang Challenge drivers. They're going to be able to do 2-hour-long races on La Sarthe, the full track. How cool would that be? Hearing that Coyote engine wailing in the middle of France, you know, that's what gets us excited. So it's not only a race for Mustang GT3 and GTD, but it's also a Mustang Challenge moment for us. And we're going to have a car corral with Mustang owners from around UK and Europe. It's going to be a great event. But we are going there for one reason, to win.
Yeah, someone said you don't collect third place trophies, if I heard that correctly. So Mustang, they're planting the flag there in France this year, but also across the globe and also mostly in America. Jim, thank you so much for joining us.
Thank you so much.
Appreciate
You're
it.
the best.
That'll do it for today's Market Domination Overtime.
Don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned. Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. A roller coaster of a day for markets, with the Dow, Nasdaq, and S&P all giving back gains and ending the day lower after President Trump announced tariffs against Canada, Mexico, and China would go into effect Saturday. We're going to dive into the rest of today's market trends. Then Palantir will kick off another major week of tech earnings. That's Monday. We're going to tell you what to expect. Plus, remember the TikTok ban? Might feel like ancient history, but it was just a few weeks ago. With the app still in limbo, we're going to talk to the CEO of Triller about what opportunities could exist for other social media companies. But first, President Trump is confirming he will put tariffs on semiconductors and oil and gas, among other things. We can expect those oil and gas tariffs by February 18th. Joining us now to break down these developments is our own Washington correspondent, Ben Werschel. Ben, what is the latest? Walk us through it.
Yeah. So President Trump just held forth on this at length with reporters in the Oval Office, and we're still going through exactly sort of some of the details, and we don't have official documentation, but a couple clear takeaways. One is the oil one that you mentioned. Oil tariffs, oil has been a big issue. We talked about it earlier in the show, are going to be lessened to some extent. Some are going to be, he's talked about a 10% duty that may be coming into effect as soon, but some, as you mentioned, will be delayed. So oil has been the kind of last minute sticking point, and it's clearly something Trump is backing away from a little bit on, at least in these initial ways. On other fronts, though, he's clearly gung-ho on it. He also told reporters that there's nothing, apparently he said there's nothing Canada and Mexico can do at this point to avoid some of the other duties. So he's sort of gung-ho on those going forward immediately tomorrow morning, and he's going to use emergency authority that could make them in place very quickly. And then the third is a sort of range of other tariffs threats that he offered. Pharmaceuticals he talked about. He said he would, quote, absolutely put tariffs on the European Union, but again, there's not timing there. And then the chips one as well, talking about tariffs on there, but again, the timings are unclear. That did come after the NVIDIA CEO met with him earlier this afternoon. So it sort of reaffirmed kind of an aggressive stance from the White House, from the Trump White House right now on chips, export controls, tariff, all these issues that we've seen all week.
With Mexico and Canada, Ben, what is Trump trying to accomplish with these tariffs? What's the objective?
So the stated objective here is fentanyl and illegal migration. That's been his reason for both of these, Canada, Mexico, as well as China. And the way they describe this is the kind of the first wave here of what they plan to be additional tariffs to come. I think the actual answer to your question there is a little more complicated because there's a lot of things at play here. He's talked about raised tariffs to raise revenue, and clearly invested in that. He's had a lot of sort of differences, and he's focused especially on Canada, which is kind of the least likely country to be sort of in focus for fentanyl and migration. So there's a lot of answers to that question. But the sort of way they're stating it and the way they're kind of going to go forward with this tomorrow, apparently, is around fentanyl and illegal migration.
Ben, great to see you. Thank you for joining the show. Appreciate it. U.S. stocks closing lower as Trump recommits to sweeping tariffs. And Yahoo Finance's Jared Blickery joining us now with the trading day takeaways. Jared.
We ended the month a little bit ominously, but we had strong performance throughout the month and also when indicated with the flows. And let's get to our three things here. The first is January's a wrap. So let's just kind of go over some of the performance here. I'll show you the sector action first. And in the meantime, well, there we have it up there. Let's get to that. 7% for healthcare. Financials take second place. That's almost up 7%. XLC's communication services closed at a record today, up 10 days straight. Then materials and industrials. That is a healthy mix here. And you will note that tech closed negative. So what if the AI trade reasserts? Yeah. Well, we had the chance to talk to Mary Esposito. She is an influencer, and she's also kind of a new trader. She's been an influencer and a small business owner for 7 years. But on Stocks in Translation, we get to talk to people from all walks of life and all investment levels. And here's what she had to say about this market environment.
I've adopted my strategy to instead be dollar cost averaging, because instead of investing
Warren Buffett, yes,
huge chunks of money at different random intervals trying to time it, it's like time in the market instead of timing the market. And so now I can automate my trades, and so I'm investing smaller increments, but more periodically and consistently. So I might catch a high, I might catch a low, but overall as the stock market rises, I'm still, gaining a considerable return.
So just keep feeding that money into your retirement account. And I should add too that we had some record flows in January. Cash, that was a record January inflow. Treasuries as well. EM stocks. Now, we haven't heard of emerging markets. We're going to touch that on a little bit, but the list goes on here.
So end of January, I have to ask you, January seasonality, Jared.
Well, guess what we have for you, Josh? 2025 is now leaning bullish, and we're going to talk about exactly that, January seasonality, because as January goes, so the saying goes, so goes the entire year. And here's what we have here. Here's this green line. This is January positive performance. For the rest of the year, we tend to have a total performance of about 17%. When we have a negative January, we tend to have negative performance for the entire year of 2%, negative 2%. And if you take out January from that equation, just the rest of the year, February to December, guess what? 87% of the time we have average returns of 12%. And for a negative January, which is what we do not have right now, that drops to 60% with only 2% return. So looking pretty positive already for the rest of the year.
Final point from Jared Blickford.
All right, let's move it on here to international stocks. They are lit in 2025. I mentioned emerging markets before. This has been dead money for basically 2 decades, but I'm going to show you our indices year to date. And I know we got a lot of letters on the screen here. I'm going to decode them for you. GDAXI, that's the DAX over in Germany. That's up 9%. Then we have 7.7% for the CAC 40 in France. The IBEX is in Spain. That's up 6.7%. Then 6.1% for the FTSE, 5% for the KOSPI. In Brazil, we got 4.9% there. Then we get to the US. This is the Dow, 4.7%. So my point is, I haven't seen this kind of setup for a long time, but international stocks looking pretty good right now.
Very quickly, what is driving this, Jared? What's driving the strength in foreign stocks?
Believe it or not, lower dollar. And that plays into tariffs, going to be the big discussion of the year.
Thank you, Jared. Appreciate it, buddy. Today, Palantir shares hitting a new intraday high, with investors anticipating its Q4 earnings report on Monday. Palantir will kick off another huge week for tech earnings, followed by Amazon and Alphabet. Its report will give investors an early clue as to whether or not the AI train will continue to roll. Joining us now is Derek Yan, Crane Shares Senior Investment Strategist. Derek, great to see you. So Palantir, listen, I mean, the stock has been a monster, Derek. It's up more than 400% over the past 12 months. In this earnings report, Derek, as you comb through it, what are the questions top of mind for you? What do you want answered?
Well, I think all eyes is on the AIP platform, right? So I think AIP is what's driving the 400%, or the stock went from 40 to 80 now. So all the investors should curious about the execution of their AIP adoption among their enterprises. That is the key driving force for the stock going forward.
Derek, I mean, you're right. A lot of investors decide, listen, this is a very smart way to play that big, broad AI trade. Do you believe that, Derek?
Well, I think we're now in the status where the value is migrating from the AI hardware to AI infrastructure and applications. So our AI ETF AGIX is kind of positioning that we hold Palantir in our holding as a play for the AI adoption. Because now, you probably seen what happened with DeepSeek. This cost of AI models, we're going way down, but that's going to benefit a lot of AI adoption and AI application companies. So we see Palantir is kind of go-to operating system for enterprises. Their ontology system, they can break down the data, logic, and action for each company, and creating this context layer for the large model to train those data and implement it in different user cases. So I think that trend, it just started. It's going to be a great year for them in 2025.
So you see, Derek, as Palantir, another name that could potentially benefit by these cheaper, powerful LLMs?
Yeah, exactly. I think LLMs is now, previously everybody's doing the pre-training AI scaling. This scaling law is happening in the pre-training phase. Now, it's all task time and reasoning, which is cheaper, right? I think that is gonna bring a lot of capabilities and use cases for large language model starting from this year, and you're gonna see that happening very soon.
Given, Derek, listen, it's Trump 2.0, backdrop, geopolitical tension, conflict. What does that potentially mean for Palantir's government business going forward?
Well, Palantir has been very strong in government business. Well, anytime there's a geopolitical event happening or tension happening, I think that's a catalyst for Palantir, and especially for Trump administration. I think they have a goal for better government efficiency and put like government like a security and safety as a priority. All those I think could become like a potential catalyst for Palantir going forward.
Last question, Derek. You look at the stock move, 400% over 12 months. Do you think part of that could be that investors, beyond the tech, they also see Palantir as a name that, just has strong ties to Trump? You think about Peter Thiel and Joe Lonsdale. Do you think that could be playing into this as well?
I think some investors are looking at that way. As we are true believer in the AGI, artificial general intelligence. For us, Palantir, it will be an operating system for enterprise to in terms of like AI adoption. So I think instead of like looking at more on the government sector, its commercial sector actually has more potential. I think investors should be looking at.
All right, Palantir earnings on deck. Derek, thank you so much for your time today. Appreciate it.
Thank you.
Coming up, we're going to dig into trends in the social media sphere, including the future of TikTok. More asking for a trend that's right on the other side. TikTok is hanging in social media purgatory while the app remains operational in the U.S. for now. Trump administration is trying to come up with a solution before the extension ends in April and the app shutters again. But that poses some interesting opportunities for other social media companies, and we have the CEO of one of them joining us now. That's Sean Kim, CEO of Triller. Sean, it's good to see you. So Congress decides, Sean, TikTok is a national security threat. Supreme Court upheld that law, but President Trump has different ideas, wants to try to get a deal done. We'll have to see how this plays out. Against that backdrop, though, Sean, of such uncertainty, I would imagine there are creators who are looking for TikTok alternatives, like the platform you're running. What are you doing to attract them, Sean?
Yeah, so this is a really interesting conversation. Our platform is 100% focused on helping creators build their businesses. And so our mission statement is become the most creator-focused social platform in the world, offering discovery, monetization, and ownership, right? So social platforms are good at discovery. They help your creators find the audience to watch the content. They're somewhat okay with monetization, right? So you see roughly 4% of creators around the world make over $100,000 a year. Of that, only 77% are making money through brand deals. So, and these brand deals are actually done off platform, right? So most social platforms are not giving you the tools to actually make money on the platform. And lastly, ownership. No platform gives you ownership. So that's something that we're going to offer on our platform. So, with creators that come to our platform, they're going to have full access and ownership to the content as well as the fans, so they can communicate with them, whether it's on platform or off platform. So that's something that we're going to offer. We're the underdogs, but we can make quick decisions. We can move fast. We can do things that the platform is not willing to do. And that's what we're going to do on our platform.
Sean, how popular is Triller? Can you quantify that for us? What kind of eyeballs, what kind of traffic, and who's your demo?
Yeah, so a lot of Gen Z, a lot of younger users are on our platform. We have seen a 10x increase in users coming to our platform when the TikTok ban was happening. It's actually really quite interesting, right? In the entire scenario of TikTok getting banned, it shed some light on some fundamental issues. Basically, the complete disregard of the creators and the brands and the user on the platform. Right. So when the app went dark, 170 million Americans and millions of creators actually lost access to their content, and they had no way to communicate with their fans. So what we actually, it's because ultimately they didn't have ownership or control. And what we actually did was we knew that was going to happen. We actually built something called SaveMyTikToks.com. Right. And this basically helped the creators save their TikTok videos, store it, allow them to download to their desktop, as well as upload to Triller. And in that time period, we had like millions of videos actually stored and to help these creators out. And that's something that we're willing to do, is give them that free service to help these creators during this time period. And again, we're all about giving that creator the ownership. So on Triller, that will never happen. You'll always have ownership and control of your content, as well as the access to fans to be able to communicate with them off platform and on platform. In terms of monetization, we're going to offer all different ways that creators can monetize on our platform, whether it's through branded merchandise, e-commerce, live stream gifting, subscriptions, ads, sponsorships. So if you look at people that make over $100,000 a year as a creator, on average, they have over 5 different revenue streams. So we're going to offer all the different ways that creators can make money on our platform.
Sean, you know TikTok very well. You used to be its head of product, I believe. So I do have to ask you, given that resume, given that background, when Congress says TikTok is a national security threat, what do you make of that?
Hey, so the U.S. government did their research. They passed a law saying that it should be banned, and we're going to uphold the law. So that's as much as I can say about that. But we're here as a platform to help ensure that if something does happen to that platform, because there's a lot of uncertainty there in the next 70 days, who knows what's going to happen, right? So in that scenario, our platform is here to ensure that we will provide all the experiences that they can to help them succeed on our platform in terms of monetization and ownership and discovery.
Sean, appreciate your time today. Thanks so much for joining us.
Thank you.
Coming up, what to watch next week. We're preparing you for the market action ahead. More Ask for a Trend on the other side. For our chart of the day, we're looking at lessons learned from the trade war during President Donald Trump's first term. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
You know, Josh, if there's one thing I take away from the various conversations that we had today, it's that we don't know what's going to happen. We don't know exactly what tariffs are going to be imposed this time around, and we don't know the effect it's going to have on either inflation or growth or a lot of other knock-on effects through the economy. But one of the things we can do to try to figure out what might happen is look at the tariffs that were imposed in the first term of Donald Trump's presidency and the effect that they had. And one of the debates that's going on this time around is, will these tariffs be inflationary and or will they affect growth and have a downward effect on growth? That's something, of course, that the Fed is trying to weigh as well. So Bloomberg took a look at the Federal Reserve growth forecasts for the year 2019 and how they changed as the various tariff announcements were made in the first Trump term. Now, they first came out with their various GDP estimates a couple of years earlier. As we know, they look out quite a ways, and they were around 1.9% or so back in 2017. Then, by the time the steel and aluminum tariffs were imposed, those growth forecasts had come up. Then the tariff on China were imposed, and then you saw that sort of downward effect begin on the growth outlook. Then we had China tariffs being escalated, Mexico tariffs were threatened, and China tariffs eventually were increased. So net, the growth forecast came down as a result of all of this, and that's something that's also reflected in the people that we're talking to, including Ernie Tedeschi, who we talked to at the top of the show.
Our estimate is that this slate, again, assuming that it was implemented on all goods, would probably translate eventually to a lower level of real GDP of 0.2% in the medium term. And by that, I mean like after 3 or 4 years. So that's meaningful. On the other hand, the Fed has said that in terms of inflation, it's going to try to look through the tariffs, meaning that it sees tariffs as a one-time price level increase, not inflationary, but just something that affects the price level once.
But as Tedeschi also said, Josh, it's going to be really hard to figure out specifically the effect of the tariffs versus other inputs into the economy.
All right, Julie, thank you. Appreciate it. Time now for what to watch next week. To start off here on the economy, the countdown to President Donald Trump's tariff deadline is getting close, February 1st, marking the potential start to a tariff campaign that Trump has been pushing for months. And turning to earnings, it's another big week for the Magnificent Seven. We're going to get earnings from Google parent Alphabet as well as Amazon. Alphabet reporting fourth quarter and fiscal year 2024 results Tuesday after the close. Analysts will be listening closely to a wide range of topics, from the company's AI spending forecast to the DOJ's proposed divestiture of Chrome. And then Amazon is announcing results for the fourth quarter on Thursday. That's after the close. Key focus for investors will be how its cloud business, Amazon Web Services, is performing. And taking a look at the job market, a lot of new labor data coming out next week, including Friday's jobs report. Economists forecasting 150,000 non-farm payroll jobs to be added, while unemployment and hourly wages hold steady at 4.1% and 0.3%, respectively. That's a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.